Aman, thanks for visiting.
Yeah,
How's it going today?
good man. Thanks for having me.
Yeah, for those of you that don't know, Aman is a good friend of mine from university, and he's actually the one that encouraged me to become a mortgage broker, as well as taken me on as one of his students. So I'm a business partner of his now, and he's given me the opportunity to cut my teeth in the mortgage industry. So I really appreciate that.
Yeah, no, for sure. And I appreciate our partnership as well. You're not a student, you're almost a master. You've been doing great. It's been almost what, 6 to 8 months now, or almost a year almost.
Closer to a year,
Yeah,
closer to a year.
yeah,
And just it's funny how we got reconnected again,
yeah.
because there must have been a long decade where really on, we weren't talking to each other because we kind of just moved on with each other's lives after we graduated because we went to Laurier together, undergrad,
Yeah.
and after that, people drift apart, but the internet is a beautiful place and it got us reconnected again. So
Yeah, no, for sure. And I think it was just like a random a message on Instagram, and it said, "Hey, let's catch up over a coffee." And it wasn't even intentional for business on my end. It's never intentional. It's just more so like we knew each other at Laurier, so at the end of the day, getting a quick coffee to catch up, it's always great, you know?
yeah,
Yeah.
that's absolutely, like, really, it's true. Like, it's funny because when time goes by, you're focused on different things, and then the people in your, like, I guess your past life, you can say, they're still important to you.
Yeah.
But it's impossible to literally keep in touch with everyone all the time.
Right.
And I'm glad. I remember. I mean, it wasn't a great time at that time. It was like my grandma just passed away, and it was a really rough week and weekend for my family. But we had a chance to speak, and you extended your condolences to me, and then we kind of just reconnected. And it wasn't just coffee; we had Osmos as well. So
Osmos, yeah.
that's right.
Classic. Yeah. No.
So no, thanks for coming on today. And I haven't made a lot of mortgage content, and honestly, this is people have been bugging me about it. They're like, "Hey, why don't you do mortgage content?" I'm like, you know what? As soon as I do mortgage content, the person I got to bring on is definitely you.
Yeah.
So we're here today, and just based on, let's talk about some of those files that we've been working on and what kind of things that we've seen this spring in terms of trends wise in the mortgage industry right now.
No, for sure. A lot of files these days, a lot of pre-construction closings, whether that's in Ontario and Alberta. Our team, for those that are listening in, is licensed in Ontario and Alberta. So we have a lot of influx from Ontario investors that are buying in Alberta. They're pre-construction projects. These builders are guaranteeing rental income for the investors. So it makes it a little bit more turnkey. A lot of files these days, clients are putting down 10 to 20% on a pre-construction, but there are certain instances where individuals have 10% down, and when it comes to closing, they projected that they would have the full 20%, but by closing time, they're short to 10%. So how we've been helping these type of situations are that we have specialized programs with some of our lenders where we can use the market value, long as they purchased the pre-construction over a year ago, to use the market value if it's up. In most cases, it is. In certain cases, it's not. That's a different conversation. But if the value is up, we can actually use the market value of the condo and help use that equity built towards their down payment. So a lot of those files coming in where we're helping them utilize those programs. Generally, just a lot of pre-construction closings these days. In the GTA itself, we're finding that it's a little bit slower on the resale, mainly because most of the homes in the GTA are, up there in the million range or high, eight, 900,000, and a lot of people can't qualify at today's rates. But generally speaking, there are still some closings coming in, people needing refinances depending on their situation. So each file is unique, and the first step is we usually see how we can support the client and then go from there.
Yeah, and we have to mention this, those appraisals being short. That's been something we've seen a lot as well on the pre-con side. The
Yeah.
closings are coming up. What are your thoughts about that?
Yeah, so anyone that's bought, I would say in the 22, maybe at the peak, call it March, February of 2022, a lot of those individuals that bought pre-construction on speculation, not to necessarily live in there, but I mean, regardless of living in there or not, the values right now are kind of coming a little bit hit or miss depending on the area that they bought in. So generally, the way it works with the bank is that the bank will appraise the property, and they will do 80% of the lower of the two, whether it's the appraisal or the purchase price. Sorry, I should take that back. With the banks, it's always the purchase price, but with these specialized programs, with the market value program that I mentioned earlier, they can go 80% of the market value. Now, with these individuals that bought at the peak, the values sometimes are coming back shorter. So what happens in those situations is that individuals will need to make the difference because the bank will go against the value, which is shorter than the purchase price. So individuals will need to come up with that difference to close, right? Which is sometimes difficult if they're already putting down 20% and the value is $50,000 less. Like finding 50,000 is not easy, you know?
It's definitely not easy, and we've been getting a lot of people asking about those things, and those are not the easiest conversations to have, right?
Right.
It's stressful for their families as well,
Yeah.
and as the price, the higher it is, let's say 1.4, and then you're getting appraised now for 1.2.
Yeah.
I mean, it's getting a little bit, not on the healthy side.
Yeah, and I don't like to see those situations. Obviously, we're in the business of helping our clients,
Yeah.
and when we see these situations, it's very a difficult conversation to have. There's not a lot of options because generally speaking, the appraisal companies they're not out to get anyone. They just their job is to make a fair market value of the pre-construction. The challenge right now is that the resale market. So if you bought, for example, a home in Barrie, a detached home for 1.2 million, and across the street there's ready resale homes going for 900 to a million, similar size.
Yep.
Okay, this one, albeit is brand new, but the other ones are pretty comparable in size and maybe 3 4 years old. You're getting a house for $300,000 less. What are the clients going to do? Like, is it really going to make that big of a difference if it's brand new? Most of the time, not. And just to add on that, sometimes individuals that bought pre-construction, they're buying it for rental purposes, and sometimes these individuals don't understand that you have to bring the HST up front.
Mm.
The HST, then they have to pay, it could be 24,000 plus. And, there's been instances where clients don't budget for those things.
That you're definitely right about that. Not
Yeah.
only for that, but closing costs as well.
Closing costs, if you have to go through some alternative lenders, there are sometimes additional fees depending on the file and whatnot. So,
So we always advise our clients, well, we kind of give them a checklist ahead of time, let them know in advance, especially if they're going through the B side, there could be a broker fee or lender fee as well. Just things to consider for them, and always budget on the higher side a little bit. The worst case scenario is you just don't have to spend that money, right?
yeah, there's been instances where, for example, you and I, we've even consulted clients where they're calling us, hey, we're looking to buy, and we look at their situation. Sure, they might have almost to 20%, they're almost there, but in certain situations, their debt load might be high, or you have to have a car payment, they don't qualify. We rather advise them, look, keep renting for now until your situation's a little bit stronger, and then look to see to buy. Because at the end of the day, when you're buying a home versus renting, having a house is also a luxury because that monthly payment, you have to make sure that, for example, if you're buying a condo today, your monthly payment, let's say on your mortgage is 3,000, then you have your condo fee $600, property tax, let's say another 250, then you have your utilities, you have other expenses as well that we won't get into. But generally speaking, if your monthly cost of living in that condo is 4,500 versus renting it for 3,000,
Mm.
we have to do the math, what makes more sense for the client, right? So in real estate, as you can probably appreciate, when you're buying an investment property, it's a little bit of a different story, right?
Yeah, it is different because you're getting a rental income and owner occupied. Actually there's no price on owner occupied. I talk to different people all the time, different clients, and friends as well, and the value of owning a property for them, having their kids have privacy, people being able to come over and not being able, no, having that freedom to do what you want at your own place, that is something that is priceless, regardless of
Right,
cost, right?
right,
And then you look at the investor side where it's all dollars and cents. I don't mean that from like a greedy point of view. What I literally mean is that if it doesn't make sense from a dollar point of view, from analysis, then we shouldn't buy that property. But I've seen the other side as well, right? Like where uh, parents, they love the property because it's close to the school,
right.
right? And they're willing to buy properties that are a little bit more on the I wouldn't say expensive, but just the market dictates the price. They don't dictate the price.
Right.
So, but they're willing to because of those emotional reasons, which are just as valid. You know, being a parent, you want the best for your kids. You want the house in the proper neighborhood, right? So, investors and owner occupieds are completely different. And having said that, your clients or our clients come to us and they've been kind of in those pickled situations, you said a lot of them are speculators, right? They're not all owner occupied. Is that correct?
For pre-construction, you mean?
Yeah, for the
Yeah.
pre-construction ones.
For pre-construction, yeah, a lot of individuals back in 22, the market kept
Yeah,
going up, up, up. Back then, 2020 to 22, literally, if you sign a contract, a piece of paper,
yeah,
a couple of months later, you would be up 20,
yeah,
30,000. So assignments were huge back then. And yeah, to your point, speculation is very dangerous in this industry. Sometimes I can relate. You don't know what the market's going to look like down the road.
yeah,
So you have to have that mindset and be prepared for the worst case scenario. Hope for the best, prepare for the worst.
yeah. I think I haven't bought a pre-con before, but the like the resale homes, like older homes, that's what I've kind of specialized in, made a niche for that,
Right.
fixing up older places. And you got a budget like literally for the worst, like everything. Like even though some things are looks fine, you still should put like set aside another like 10% for incidentals. You never know,
Right.
right?
The rainy day budget and doing those type of projects, which I guess we can get into next,
Yeah,
are a totally different level than pre-construction and just regular resale. But going back to that point earlier about owner occupied versus rentals, I just wanted to comment that with owner occupied property, like I would consider it a luxury. To your
yeah,
point, there's benefits of having your own place. Sure, the market will go up and your value of your home can go up. And a lot of individuals they call me, yeah, what if my house goes up 400,000 or 500,000? That's great. But one thing to keep in mind is to access that equity, you have to qualify for that loan amount and you're
yeah,
taking on essentially more debt. Now, the difference with the rental properties is if the value goes up, you can access that equity as well, but you also have a tenant that's helping you mitigate that negative
yeah,
or positive, like hopefully positive cash flow from the rent to whatever the payments are on that
yeah,
property, if that makes sense.
yeah. It does, depending on the market, of course, right?
Market and yeah, where you're buying the region, etc.
Yeah, but the refi and access to equity, it's not automatic. Sometimes clients will come and they'll assume it's automatic, like,
Right,
oh, it went up by 500,000, but their income hasn't increased very much since, 8 years ago, 10 years
right.
ago when they bought originally. And then also maybe one of their spouse, like there's a partner, like husband and wife, maybe the other person is like retiring,
Yeah.
and then they're not going to be able to qualify, right? Because they don't have the income to support it, but they think that automatically for some reason they're able to get it. It's not their fault for thinking that. It's just we need to educate them.
Right, and there's been conversations on that note as well, where people have a lot of equity in multiple homes,
Yeah,
which is wonderful and great. But the thing is, the banks, they'll look at it, but it won't really help strengthen your application if you have like equity in a bunch of homes. The main way to really look at it in a healthy way is how can you qualify for that equity, right? Like
yeah,
I have individuals that now are retired and they have multiple paid off homes, which is wonderful. But with their pension income, they won't really be able to access that equity. Now, there's a variety of different programs. We have like access to over 80 lenders. So there's always programs and products available to help certain clients. Each situation is different.
yeah,
For example, if you're a retired individual, you can use a reverse mortgage product if it's owner occupied program and whatnot. So there's a lot of caveats to it. But
yeah,
my point is that sometimes people have equity and, they sort of come to me when the file's not qualifying properly and say, hey, look, we have over $1 million in our property,
yeah.
which is great, but technically you can't qualify for that $1 million, right? So that's the challenge in some cases.
It's like in summary, it's not automatic,
It's not automatic. No,
e-
never.
even though some people may think that it's automatic. But like I said, it's just a matter of educating people. And it's funny that we're on this topic because my dad, before he retired, my dad still works like with my uncle. They do construction together and they renovate properties. But before he retired, because he worked like a job before, like a 9 to 5 job. Um, he worked at Chrysler in Brampton, and he
Right.
retired in 2021, like right after, maybe like a year after COVID, and before all that stuff. So he had a lot of friends around the same age retiring, and they prepared. in advance before retiring,
Right.
access that equity. Because as you may, you know, and you've seen a lot of clients as well, there's this millennial generation where they get a lot of help from their parents with the gifts, from the
Right.
equity. So that was something that my dad had mentioned to me and to our family, saying that he's seen like this huge trend of people his age before retiring, literally preparing for those refis in advance, knowing that at some point when they're collecting retirement pension and things like that, their income is significantly impacted.
Right.
That's pretty much like that. That's like, and I never really thought too much about it until we talking about it today,
Yeah,
really.
it's a good point. I mean, getting access to a line of credit is some, you never know when you're going to need it. But going back to the point earlier, every situation is different. So I don't want like
Yeah.
viewers to the audience to say, hey, you quoted me on this. But look, at the end of the day, everyone's situation is unique. Some people might have a lot of assets built up throughout their work life and now they're retired. Sure, their pension income's less, but if they have a lot of assets, there's different programs and different ways to present the file to certain lenders to get approved. So everything is different. And if someone's listening, they might have a specific question. The best thing to do is reach out to you and I, and we can see how we can support them better.
Yeah, that's for sure. Not to make it sound like a commercial, but just
No, just to like caveat, like, look, at the end of the day, I don't want someone quoting us on certain
yeah,
things. Every file is different. My financial situation is different. Your financial situation is different, so on and so forth. So, something to consider.
yeah, and especially when things are taken a little bit out of context, you're right. Like
Yeah.
especially if you're just listening to a certain part of
Yeah.
the show, you're gonna think like, hey, this is what it is, and then you tell like four friends, and then it ends up being like, a broken telephone, right?
Yeah. Yeah.
So
Yeah, you post it on TikTok, and the next thing you know, there's like some guys commenting in this, or whoever commenting, trolls commenting in the section. So just wanted to caveat some of the conversation there. Yeah, why don't we talk about doing burrs and like renovation projects and stuff? That's your specialty.
yeah, so I mean, when you say it's specialty, it sounds like I don't want to make it sound like I'm
Yeah,
this expert at it. I'm still learning and growing from these experiences. But from my experiences so far, I'll be fully transparent. I have not successfully achieved a full complete burr, meaning I've got 100% of my equity out,
right,
right? I haven't been able to do that because there's three reasons. Well, we'll just start off with one reason at a time. I don't know if there's three reasons or not, but there's one of them is the price at which I bought the property at. It wasn't so much below the market value that there was built-in equity. And the reason simply was, as an inexperienced new investor at the time, I just wanted to get into the market,
right,
right? And then the second thing was just maybe over paying for certain renovations and not, I wouldn't say not planning ahead of time, but things end up happening and then your renovation budget goes over,
right,
right? And then the third thing is that I can think of is the things that you don't, you as you unravel things, you notice that the property itself would do better with certain capital expenditures. So I'll give you a really good example of that. So I never budgeted windows in my most recent Burr project, right? My budget was really on point. So this is my third project at this point, and it was really close, but I'm going 13 over just because I'm putting in brand new windows, which I
uh,
could have gotten away with not doing, but
right,
knowing like, hey, I'm gonna have like, honestly, I don't want to be that guy.
yeah,
Let's be honest here. Like I renovated the house and I was inside the house and I could see in the winter, while I'm standing there at night and talking, I can see like the frost kind of like that humidity sort of just on the ceiling, and I know it's because the window, like it's not really blocking any of the air or anything like that, and these windows are from like the original build. So
right,
putting an extra 13K, it's putting me over. But could I have done without? Yes, maybe. But then I mean, like I have great tenants right now. They're gonna move in.
wonderful,
I mean, at the time of this recording, they're gonna be moving in tomorrow. So I mean, like that possibly helps, like encourage a good tenant decide between two or three properties. Mine is better because of maybe brand new fixtures and windows.
yeah,
So things like that, right? So I'll kind of just describe briefly. For those of you that don't know what a burr is, I'm sure this term is very, like, it's like loosely thrown around and kind of marketed a lot as you buy a property, it's a little bit like needs work done or a lot of work, you fix it up, and then after that you refinance and you pull out. The goal is to pull out 100% right? Of all your costs, down payment, renovation, budget, and then you buy another property. It's just rinse and repeat. But the reality is that for me personally, I know a lot of real estate investors, locally, that are in the GTA that invest a little bit further out. They've had really successful burrs, right? And I'll be openly and honest about my situation. Mine have not been 100% all equity pull out, but a lot of other people do, and I'm still trying to learn and grow. And as a result of that equity not being completely pulled out, you're gonna have you're gonna have some of that inside the deal still.
Right.
So I mean, can you go and do another property right away? You might have to raise more capital or put in more of your own money, whatever that your situation is. But what I've seen is that the lenders that we've worked with, this was like two of them. Two of these projects were before I was partnering up with you,
Yeah.
right? So two of these properties when I was working, the lenders and the appraisal companies, they were working with us. They're not working
Right.
against us. They want to see us succeed. But we need to be able to prove to them that these projects are viable,
Right.
and we need to be able to put in, like, there needs to be some value increase.
Yeah.
So you got to be really strategic. You can't just do whatever you want. You can't be spending a ton of money on things that don't need to. You got to be really strategic.
Right.
Like, you need to choose the right things. Flooring is one of them. Paint, lighting. Those make big differences, right?
Right.
You don't need to go crazy with like granite countertops.
Yeah.
Brand new countertops are fine. Paint your cabinets. You don't need to go crazy, and that's what I learned from that experience. And I'm still undergoing one project right now, which is hopefully going to be completed soon. It's been like 6 months, close to 6 months,
Yeah.
but it's because it's going through a permit process. And with the permit process, you got to go through a inspection and all these other things too. So it is what it is. But I'm happy to share. And obviously, if you want to learn more offline, I could definitely show you
Yeah.
pictures, videos, anything that you want. Not that I haven't been showing them online, but
Yeah.
yeah, that's been pretty much it so far for that.
Yeah, and like even on our end, we do a lot of these financing for various clients, and we have specialized lenders that specialize, for example, in burr lending. Now, it depends on the house itself, but going back to your point on the budget,
Yeah.
you never know. You open up the skeletons in the closet really is applicable to these type of projects. In my experience, it also depends on what your exit is. So, for example, you mentioned granite counters. Are you building this for who? Like, who is it going to be? A student rental? Is it going to be rented out to a family? Are you duplexing it? But in my experience, the ones that, like to your point, if you can get everything 100% out, that's great. Now, uh, another way to look at it as well is if you find a house that's, let's say, uninhabitable, we have lenders that will consider it. I'll give you an example. I had a bunch of these in the last 6 months out in Kingston, Ontario. Kingston is a great market. They have Queen's University, they have St. Lawrence College, 3 hospitals, and the military base. So there's a lot of upside in that community. But going to some of these projects, my clients bought for 350 to 400, which is not a bad price point. They went in, they did the cosmetics, just like you mentioned, the flooring, the lights, the countertops, the backsplash, new appliances. And the main key thing is that they made it into a duplex. And one thing that I've learned over doing over 15 of these, like from a financing standpoint, is that having a proper team, for example, contractors, permits are huge. So these individuals, multiple different, not just one, have access to a good architect, which helps them identify which single family homes can be converted into a duplex. Now, where I'm going with this is that they went in, they renovated it, and then they made it into a duplex. Now they've refinanced it, and they might not have got they've got their rental budget most of the time out, which sometimes is up to 100 to 150K. But the down payment they get about 80%. Some of them have gotten everything, God
Yeah.
bless. But the main point is that now they've rented it and it's breaking even or cash flowing at today's interest rates, 5 to 7%. It's cash flowing or breaking even, which is amazing. If you go to the GTA and you buy something for 800,000, you spend 200,000 to renovate it and you make it a duplex, it's probably not going to get cash flow, in my opinion. You'll be cash flow negative, and that's another aspect when you're investing in real estate to keep in the back of your mind, because obviously you don't want it as a liability, you want it as a income, right? So
Yeah.
and generally speaking, in my opinion, if you do cash flow on your rental property, you probably leave it in the property for any headaches, tenant turnover, which, we can go on and on
Yeah.
about this forever, but that's just kind of my insight around what I've seen and, experienced over the last 5 years.
Yeah. I mean, you're definitely right about the cash flow part. I recommend everybody build a reserve and just kind of let it accumulate, just because honestly, like I'll give you my experience personally. My first year of after renovating the property and renting it out, there's some things that you still need to pay in terms of like maintenance wise. You never know, things pop up, and you're starting to pay those things, so the cash flow doesn't accumulate. But then after you fix those things up, after a while, they start accumulating
Right.
big time, and
Right.
once it starts accumulating, you don't go on vacation with that. You leave it there,
Yeah.
and then one day there's going to be another breakdown or some sort of
Yeah.
capital expenditure or anything like that that you need to pay for. It's there, and it kind of insulates you a little bit.
Yeah.
I mean, it's not 100% foolproof, but there are going to be moments where you're going to have to dig into your personal funds if you need to, but it kind of mitigates and lowers that
Yeah.
because your most of your other expenses are taken care of as well. It's you budget in there with the property tax and the insurance, and then other vacancies, whatever you use to put into your calculation, which you should put pretty much as possible.
Right.
Your real cash flow number should encompass way more than just the typical, like what we kind of have in our system, right? Which is the insurance and the property tax,
Right.
right? Have as much as possible. And if it's not cash flowing based off of those numbers, still great. It's fine because you've accounted for more than
Yeah.
less, right?
It's a long-term game as well. Like, today, here's the market, which a lot of people are considering is the bottom of the market. And generally speaking, every 5 years, the market will peak and kind of go like this, right? But historically speaking, real estate has always been considered a safer asset class.
Yeah,
It's one of those things you have to budget in long term. If you're buying a property, I tell clients, if you're buying a property for investment, do not sell it for at least 3 to 5 years. If you're planning on selling it for 3 to 5 years, it could go any way, right?
yeah,
Like what we saw in the past was anomaly. What we're seeing now is more of a standard market. So things to keep in mind, right? Like a lot of people come in and they think that, okay, I'm going to buy this property, it's going to make me 200,000. Like now there's all these other things like capital gains tax, et cetera,
yeah,
et cetera. So you buy real estate, you wait, right? In long term, and to your point, capital expenditures help maintain that property. So just some things that sometimes people don't really consider. And it's also our job as mortgage professionals to
yeah,
give them this insight, right? Like when someone calls me, I don't really get excited about the deal. I think, okay, what type of advice as a mortgage professional can I give them, whether it gives me a deal or not? Because at the end of the day, I want to make sure they're in the right situation and getting the right product or financing for whatever they're looking for, right? So I think that also will lead us to the next conversation about fixed or variable, right? Which,
yeah. I mean, it leads perfectly into that domain because um, I have three variables, but
yeah,
then some people they have fixes, and some people had fixes during the low COVID times at that 1 point something percent, 2 point something percent. I mean, they're not up for renewals if they've renewed, if they, no, not renewed, but they got their mortgage at that time. But I mean, the reality is we can't look back in time, right? Right now, the interest rates are pretty high. And the thing is, what do we do? Variable or fixed? What have we been doing and what have we been advising?
yeah. So it's a good question. Now, every strategy that we recommend to our clients is based on their personal situation and their long-term goal. So, for example, if I have a client that's looking to do a bunch of renovations and they're planning on doing them within 6 months to 12 months, a variable might be a better plan for them if they plan to then refinance in the next 12 months to take some of the equity out, for example. Or they're buying or closing on a property, and they have a plan to potentially exit within a year or two. A variable might be a better option because it's a less penalty in most cases than a fixed. Now, when it comes to fixed, if someone's buying a property, they're looking to hold it for at least 3 years, we're recommending 3-year fixed to all our clients. 5-year, I wouldn't recommend to anyone at this point because we're predicting that by the end of this year, on an optimistic level, obviously we don't know what could transpire, but generally speaking, this year we're predicting that rates, or the prime rate, might go down by zero point 0.5 to 0.75. Next year, another 0.5 to 0.75. And then that enters in the third year cycle, where that would be the best time for these individuals that are on a 3-year fixed to start looking to renewing or breaking their mortgage, which is another service that we provide all our clients. We proactively reach out to our clients 6 to 12 months prior to the renewal to get them set up in the right situation for the renewal. A 5-year fix in that case, now if the rates today, for example, are, let's say 5 to 6%, and they lock in a 5-year fix for 5%, and the third year rates, let's say optimistically speaking, are low fours, for example. Now all of a sudden they're leaving money on the table, versus if they're in a 3-year fixed, it's probably a better probably better recommendation for their
Yeah.
particular situation. Again, every situation is different. With variable, you want the flexibility. If you're okay with the ups and downs, it really depends on what their overall plan is for the property in the future as well.
Okay. Yeah, you know what? I want to actually talk about my situation. So if I have three variables
Yeah,
now, and I remember when I first started investing, the person that I worked with, they put me on a variable. I was excited. It was like 1 point like something.
yeah,
And then obviously since then things have changed. And then subsequently I got more mortgages and they were still variable, right?
yeah,
But at the time, just before I even knew anything, they basically said historically variables are historically are lower
right.
because compared to fixed, not because
Yeah,
compared to fixed, because of the variability, I guess,
yeah,
going it goes up and goes down, but because
right.
it's if for fixed it's static,
Yeah.
so people that have variable historically are paying less in interest. But then why isn't that everyone just goes variable if they know historically that it's less? What's the reason?
Yeah, so it's a good comment and,
Yeah,
and question. So look, we're in unprecedented times, right?
yeah,
So we never, like back in 22, we knew the interest rates were going up, but we didn't know how high. No one. And if someone says that they knew, then they're probably lying, right? So, in my opinion, we every rate hike, we thought, okay, that's it. They're eventually going to go down, and then boom, 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 boom. Next thing you know, prime's at 7%. Like back during COVID times when rates were 1 to 2%, the prime rate was at 2.45.
yeah,
Now it's at 7.2.
yeah,
So historically speaking, I think what they were alluding to is that if you're locked in at, let's say, 5.5 on a 3-year, and the prime rate now is 7.2, but as it starts to calm down, there might be a point where it's at the same, and then it goes a little bit lower. The benefit of I have variable rate mortgages myself, and on my rentals they're like closer to 7% right
yeah,
now. I didn't bother breaking because at this point I just ride the wave and rather than lock in, and it gives me that flexibility again if I ever wanted to exit or sell one of the properties. So these are things that we customize and recommend to our clients based on their personal situations.
yeah, absolutely. And it's on their personal situation.
Right.
It's not a one size fits all.
Yeah.
So this is not like general advice for everybody. It's just but for my situation, like I saw that I would have to like burr at that time
Yeah.
and refi them. So breaking them, I guess, would be viable. But then I still went with the variable after breaking them. It's also because I'll be honest with you, like I'm still going off of the statement of historically variables have been lower in interest payments compared to fixed. So I was kind of in the mindset where if that's true, I'm going to stick with this because if I still cash flow, I'm not in a bad position,
Right.
even at that higher interest rate, right? So I'm gonna just kind of like leave that at that because if it goes any higher, I'm going to lose my hair, of course. But I do, you're right though. I think that there is a lot of market sentiment and optimism that things will go down. I mean, it's been high a lot for a long time, and I think that what the government has been trying to do, they've achieved a lot of it, right? The fight of inflation,
Yeah,
the fight against inflation,
right.
and we reached like the last I guess measurement was like a 2.7 or 2.6% inflation,
Yeah.
right? So we're heading down that path, and it looks positive, right?
Yeah, we're going the right direction. I mean, what's going to happen? It's hard to tell, but
Yeah,
what I've been hearing and what our experts are commenting is that so we have a rate today's June May 31st. There's a rate announcement next week, June 5th.
yeah,
June 5th rate announcement most likely is a 50-50. It's probably going to be a hold in my
yeah,
opinion. And July, where people are betting that it's going to be a quarter point
yeah,
decrease. So right now, for fixed rates, for the audience, just for their reference, they fluctuate with bond yields. So bond yields over the last month have been going up. But looking back, for example, I had a client come in January and the original rate that we got him was 5.8, and that time bond yields were looking very healthy. They were going down and down and down. So when bond yields go down, we actually provide this service to our clients where we're able to get rate discretions as the bond yields fluctuate. So as they go down, we're able to lock them in. So for this particular client, as an example, we got him down to 5.49, and as the bond yields continue to fluctuate down, got him down to 5.29, 5.19, and then we closed at 5.09.
yeah.
So clients were ecstatic. Sometimes, we get calls all the time. Hey, like, what's your rate? Like, we have to explain to these clients that it fluctuates, right? Like 1 week it's this, 1 week it's that. And sometimes they think that we're making this up, but it's actually at the end of the day, we're here to help. We like, respectfully, our job is to provide the right solution. We don't really look at the compensation on our side of the business. Like when I say us, I mean our team. That's kind of our value. So going back to this strategy that we apply for all our clients, this is mainly for the A side of the business. We apply this strategy and exercise where the bond yields go down. It doesn't cost us anything to submit this request to our team, and we're able to lock them in as the bond yields fluctuate. Right now, it's not the healthiest situation as of today. The bond yields have been going up, but actually this morning they went down slightly. So let's see what happens next week. And next week, then if they continue to go down, that's a good sign, right? As we head into July, which they're saying at the end of July, the next July rate announcement rate should decrease a quarter point.
I mean, at the time of this recording, for sure, like by the time it's released, it's gonna like our show's released. It's gonna be a different time, but hopefully
Right,
we release it at a point in time where the information is relevant.
right.
But no, but you know, um, you're definitely on the right track. I think that personally, that's why I work with a broker before too, because I would always get that personal touch and that constant communication, right, from my broker before I, started working with you as a partner.
Yeah,
I appreciated that sort of like that sort of that sort of education
yeah,
as opposed to I guess like at a counter where everything's transactional, where you're not getting that personalized touch. That's kind of what I like to provide to my clients as well,
yeah,
based on their situation, based on what they're going through, based on their type of purchase. We're kind of giving the personalized, tailored solution for them,
yeah,
and then just add on top of that, following up with them regularly. And even today, we have a closing today, and just talking throughout the morning, and it's afternoon now, but throughout literally the entire day up to closing, reassuring the client, talking to them about everything and anything that they need to talk about, because it's as somebody that's maybe first time buyer, it's a little bit nerve-wracking, right?
yeah,
So that's why I like when I bought my first property, I went through a broker, and then realizing from that experience itself, looking back on it now, becoming a partner with you is definitely 100% the best decision I ever made, because I can kind of give back in that way.
yeah. So let's talk about that for a second, like brokers versus your local bank and banker. So, you
Let's
know,
talk about the differences, right?
yeah,
That's the key,
for
right?
sure. So the topic right now is going to your bank or going to a broker. Like, what are the benefits, pros and cons? And I'm very enthusiastic about this topic, obviously being a broker myself, and I love to explain it because I had a call the other day with a client. told me, hey, like, because she hasn't done a mortgage in like 30 years. She's getting a mortgage for her daughter, and the first thing she says, hey, brokers charge fees. I've said, no, we don't. Like, if we're working with the big banks and you qualify, we'll get you cash back.
Yeah.
We'll apply this rate discretion strategy that I spoke about earlier, and as well as, look, at the end of the day, you can go to your local branch, try to get a mortgage, and get a queue in line. But the individual at the branch, this isn't a relationship business for them. It's just more transactional, to your point. So with us, we're in the business of relationships, and we want to deliver the personalized, customized strategy for the client. Now, there's 80 plus different products that we have access to. We have access to TD, we have access to Scotia Bank, we have now access to BMO. So really, is it all about rate? I don't think it's all about rate, because each of these banks have different products, right? So if you go to TD today, they're only going to be offering you whatever TD offers. If you go to Scotia, they're only going to be offering you what Scotia offers. On our end, when they come to us, we know the policies of each of these banks because we do a lot of volume with them. So we are able to then skip the, I guess, time to really give you the solution that really makes sense for you, whether that's, you're planning on making a big lump sum, you get a big bonus from work. Some banks will give you more prepayment privileges than others. Or, for example, you might be interested in, like a cashback or whatever the case is. There's so many different nuances for each lender and product, where we come in as specialized mortgage professionals with access to over 80 different lenders to give you the right fit for yourself.
Yeah. I think that's where the one of the biggest value is, right? Which is having that variety of different options,
Right,
right? Because it's not a one size fits all, like we keep mentioning, and everyone has different circumstances. Like you might have business for self, like some people are self-employed,
right.
sole proprietor. Like it's not very like clean when it comes to taking that to maybe a branch. They're going to look at it and they're going to maybe not be able to provide them the right answers or the right sort of product, lending product for them.
Yep,
But then you come to us, those are the ones that we look at, and we have way like a lot of more options for them. And
yep,
then they don't get turned away. And it's not about like I always say B lending. B doesn't stand for bad. It stands for business for self, right? Like or like self-employed, right? It's
yeah,
not bad. People for some reason thinks A is less than B, or
yeah,
sorry, B is less than A, but B is for a different type of person, a different type of clientele. And it's like they still get the like you still get the mortgage, and on top of that too, the rate's not like excruciatingly more expensive,
yeah. So
right?
sorry, let's talk about that for a bit, because a lot of maybe the audience don't understand the difference. So
Yeah,
when we refer to A lenders, they're your top five banks, prime lenders, a little bit tighter on the lending guidelines. B lenders are, I would say, top 10 banks. There's a variety of them. They're designed for more flexibility. So with the bigger banks, they'll only consider 50% of rental offset, for example.
yeah,
Some A banks will consider a little bit more, but our B banks,
we'll do 80.
80 to 100 sometimes, right? So that helps with qualification, number one. Number two, they give you more lending room. And
Yeah,
to your point, when you're self-employed, they'll look at more so what income you're generating in rather than your net income, because there is a gap with certain write-offs and whatnot, where you can consider a little bit higher than your net income. Some banks, like A banks, to clarify, they do have specialized programs where they can look at your financials and your net income and add back to your what you've declared, whether it's a dividend or T4 from your business. But going to the B side of the equation, if you have 2 3 rental properties, sometimes you can't always qualify with the bigger banks due to their tighter lending room.
yeah,
So with these B banks, they're able to be a little bit more generous, a little bit more flexible in return. Excuse me. In return, they're taking on a little bit more risk, or giving you a little bit more flexibility, which is why they charge approximately 1% higher on the rate, which is not a big difference. If, for example, our bigger bank today is at 5.8 and they're at 6.8 on a rental, right? If it's owner
yeah,
occupied, 5.5, 6.5, right? So it's a 1% difference. There are lender fees. Sometimes we charge a broker fee on the B side. It just really depends on the file. file, and the reason that we sometimes charge our fee is because of the amount of work and the scrutiny that we sometimes receive from the lender, and the amount of effort we have to apply
The
to.
expertise that
Yeah,
we have to, use to get those files qualified
there's a
and
variety of
approved.
different reasons, and we're very transparent about all this whenever we're taking on a client, and usually we want to start with the best option and work our way backwards, right? So
So, that's pretty much it for today. I think we're definitely very closer over the time, but
we could talk about this forever. And Kevin, I appreciate your
yeah,
partnership, and I appreciate you having me here today. And I just look forward to kind of what happens in the next 6 months as the rates continue to drop, and more and more clients come to us for more specialized solutions. I think the broker side of the business as of today is taking on more market share because of the options that we have.
yeah,
It's very important to know who you're working with. So that's what I encourage all my clients. I say, look, make sure you Google the individual that you're working with, just to make sure that you're comfortable and they have a presence, they have Google reviews, because sometimes people don't take this as professionally and as seriously as they should. And like, you and I, we have those values. We graduated from a top tier business school, thank God, at Laurier. So yeah, no, I appreciate you having me here today. Hopefully the audience got some insight and value from this. So
yeah.
appreciate it.
And I will say one more thing before we go. We were not trying to trash the branches.
Yeah.
I want to say that we all bring something to the table.
Right,
That's why
right.
they both exist,
Yeah.
right? I used brokers before. I believe in the brokering business and helping people. But then also on the branch side, they exist for a reason as well,
No,
right?
absolutely.
So
Yeah.
they bring something great to the table as well. But I just don't want people to think like we're being biased.
Yeah. No,
It,
fair enough. Yeah.
like there is
That's a
a
good
time
point.
and a place to
Yeah,
go to
yeah,
the
yeah.
branch.
And
No?
yeah, we have branch partners too. Like
Yeah,
if someone, for example, we can't do the deal, they need a HELOC.
yeah,
There's certain limitations on the broker channel. There's pros and
yeah,
cons, and we want the best for the client. So if they come to us, we're not just going to give them a solution. If we know that, for example, they're better off renewing at their bank, or we can't provide that HELOC solution for
yeah.
whatever case, then we should, as our authority, recommend them to go to either a branch or one of our partners as well. So thank you for bringing that up. I totally agree as well.
And we'll talk about this again next time.
All right.
Thank you.
Thanks.
Appreciate
I
you.
appreciate it, man. All right.